It's been a bit of a week of reflection so far in the markets. Last week, we had a number of different central bank meetings, major central bank meetings at that, some big interest rate moves, some changes in language from central banks, which could really set the tone for the rest of the year. And this week has been much quieter. Fewer economic releases, obviously very quiet on the central bank front. And that means that investors have been left to reflect on what happened last week and what it ultimately means going into the end of the year and into 2024 as well. And it seems that the path which we've now set ourselves on is one of more pessimism. And we can see that reflected in the more risk-averse nature of the markets that we're seeing right now. Perhaps we're seeing signs that with the euro area heading towards recession, the UK potentially as well, China seeing signs of sluggish growth, and we're not seeing much prospect of that improving dramatically. And the Fed maintaining such an incredibly hawkish stance because the economy is more resilient, seemingly to the point that they're willing to push the economy to the edge in order to overcome that and give them that certainty that inflation can return sustainably to 2%. That's perhaps taken some of the optimism that out of the markets that we have been seeing at times this year. But it's also, again, fueled concerns that interest rates will stay higher for longer. Now, that's a message that we've heard from central banks throughout the last year, but at the same time, markets have repeatedly positioned for rate cuts to relatively swiftly follow the tightening cycle. And perhaps we're now seeing an acceptance or an acknowledgement that that may not ultimately prove to be the case. Now, today we have had some inflation data from the euro area. We've not had the Eurozone headline inflation number that comes tomorrow, but we have had some pieces of inflation data from Germany and from Spain, and that is typically the case. We tend to get a breakdown of the various countries in the run up to the Eurozone figure. And the German inflation number in particular was very positive. We saw a sharp decline. That was largely expected because of a transport subsidy last year, which created unfavorable base effects going into this month and reset itself effectively this month. So that wiped a large amount off the headline inflation number and the core inflation number too. The Spanish inflation number was in line with expectations, although it was a relatively sharp increase. But again, that was in line with expectations. And it kind of set the stage for the figure tomorrow to potentially be something that looks very promising and supportive of the fact that the ECB effectively said that they will not be raising interest rates anymore on the basis of the information that they currently have. And it's interesting that the impact that therefore has on the euro currency. So the chart we have in front of us right now is the euro against the dollar. And there's a few things that stand out even before the most recent price action that we're talking about. The most clear one is that a few weeks ago, we did see a break of this here. This is the 233-day simple moving average band. And this is what really set us up for a potentially bearish run, because not only did we see a consolidation in and around here, initially seeing support here towards the end of August before finally breaking below here early September ahead of that Fed and ECB meetings. But then also we did retrace back to that level last week and test it from below before rotating lower. So that's seen as a confirmation effectively of that initial move. The other thing that really stands out to me here is the fib levels that we've got here. So this was the high back in July going down to the lows towards the end of August, and where we peaked here on that retracement was around the 38.2 Fibonacci retracement level here, but also around the 55.89 day simple moving average band before breaking lower. And again, that is interesting because ultimately what that means is we are seeing bearish signals, and also the fact that we're seeing it around the 38.2% Fibonacci retracement level, such a shallow retracement, again, further reinforces that bearish feeling in the currency pair. So we've had a couple of notable breakouts, a shallow retracement, and a confirmation of a break below the 233-day simple moving average band. From there, we saw some support around the previous low. This is the low back here in early June, late May. And then we've broken below here again. Now, this comes after the Fed and ECB meetings, and 105 is a level we've been talking about previously. 105, as you can see, on a number of occasions throughout this year, has been a very notable area of support. Now, there could be a technical element to this, there could be a psychological element to this, because one thing you'll often see when we start trading around 105 is a lot of talk around whether we're going to see parity in the euro-dollar pair. And I do wonder whether that has a psychological impact on how people trade around these levels, and whether it encourages people to maybe lock in some profits, or it maybe discourages people from adding to positions or entering positions. I'm not so sure, but around that 105 level, on a number of occasions, we have seen that act as a major barrier of support and resistance, and we've seen it act as support a little bit today as well. You can see that we are already retracing a little bit higher today. That parity level is still a bit away, and also I think the other thing about parity as well, we very rarely actually trade below here. The only time I can remember recently, in the recent past, that we've traded below here is in that September through October and early November period. And that was a very brief time. Prior to that, we tested here back in the summer and in the early part of September. And barring some very shallow breaks below, the pair kept rebounding higher. So it's interesting that we're back around those 105 levels, that we are going to start to see a lot more talk about the potential for parity in this currency pair and what that's going to do psychologically in terms of how people are going to trade. But most important thing right here is that the recent trend is clearly in decline and in quite a bearish manner. In terms of further levels now to keep an eye on, I think the most obvious one stands out is that 106.50, because it was that previous area of support. So 106.35, 106.50. If we do see a deeper retracement, then again, looking back at those previous fib lows where we coincide as well with the 200 to 33-day simple moving average band, will be a level of particular interest as well. If we do see a bit of a corrective move, we've seen a very strong move in the dollar over the course of the last couple of months because of the now forming divergence to an extent between the language of these central banks. I think has been a primary driver of that. If we see a break of 105, then again, looking back at these previous levels, there's one area that stands out, and that's around 102.50. You can see that during this period here, we saw some resistance and some support here. And again, also, when you look a bit further down, that's when you get towards the kind of parity levels as well. You can always find other areas of support and resistance past in between here, but they're the two that really do stand out for me. Ultimately, the key for me, though, around these levels, especially going into a big psychological area, is these things at the bottom. You can see that I've highlighted here that the lows have coincided more recently with higher lows in the MACD histogram. The MACD moving averages are still drifting lower, so this is not a solid divergence. And I'd say the stochastic is continuing to at least hit the lows, if not surpass the lows, because we're already trading at extremely low levels. But the fact we're not seeing clear divergences suggests to me that we're not necessarily seeing the major red flags appear, but I think we are starting to see that very much in the MACD histogram. So if we see it follow through with the two moving averages here, if they start to make higher lows alongside lower lows in price, same thing with the stochastic, that could be a red flag that we are seeing momentum shifting, and that we're seeing a loss ultimately of momentum in that decline, especially after such a long period of declines here. So a very interesting one to watch, and one which I think we are going to see continued action in over the course of the next few months, especially if we see further divergences between the European Central Bank and the Federal Reserve. Clearly, there's still a very long way to go between now and the end of the year, and a lot can change. We've seen plenty change over the course of the last 2 years. We've seen markets be wrongly positioned on many occasions throughout that period with regards to interest rates and therefore expectations. And I think the next few months now is going to be critical. Central banks are expecting steep declines in the inflation data that could set up a very different prospect going into 2024, but they're not going to commit to anything until they see the data actually represent what it is that they anticipate, or even be better than what they're currently forecasting, especially in the case of the Fed. So if we do see moves in these figures which represent what many people expect, then going into 2024 there may be a bit more optimism in the markets. But what we're set up for right now is potentially a lot more pessimism, because investors are coming around ultimately to the prospect that interest rates may stay higher for longer, and that could come with very damaging consequences for the global economy.